Welcome to the Nevada Department of Taxation's Introduction to Commerce Tax Training. The information in this video is provided as of June 29, 2016. In this module, we will discuss gross revenue for commerce tax and how to determine the amount to report on the commerce tax return. We will begin by defining gross revenue and listing the types of gross revenue that a business might have. We will also discuss which types of gross revenue are reportable for commerce tax and which types of gross revenue can be excluded. We will also review the amounts that can be deducted from that gross revenue number. For commerce tax, gross revenue is defined as the total amount realized by a business entity from engaging in business in Nevada without deduction for the cost of goods sold or other expenses incurred that contributes to the production of gross income, including without limitation the fair market value of any property or services received and any debt transferred or forgiven as consideration. This slide lists the different types of gross revenue that a business might have. Sale of a business entity's property, which would include revenue from the sale of inventory, revenue from the sale of accounts and notes receivable, revenue from the sale of business assets, and revenue from the sale of investments. Performance of services is also included in gross revenue, as is another person's possession of the business entity's property, including rents and leases, royalties, interest and dividend income. Under other revenue, we have damages received as a result of litigation, insurance proceeds, forgiven debt, and other revenue. The boxes in red correspond to the line items on the commerce tax return. From all of these different types of gross revenue, we will discuss the amounts of gross revenue to exclude and deduct in order to arrive at the amount of gross revenue subject to commerce tax. In creating the commerce tax return, the department used a net approach to exclude and deduct certain amounts of gross revenue from being reported at all on the commerce tax return. These amounts are listed on page 2 of the instructions, which are available on our website. To illustrate the net approach, we have prepared the following example. Parent Co. owns 51% of Equileasing LLC and 60% of Builders Inc. Builders rents equipment from Equileasing and pays them $500,000. For commerce tax purposes, an affiliated group is 2 or more businesses with common ownership of 50% or more. So these 3 businesses qualify as members of an affiliated group. Revenue received by one member of an affiliated group from another member is deductible under the commerce tax law. Since the $500,000 is completely deductible, Equileasing does not need to report this amount on the commerce tax return. There are several amounts that could be in a business's gross revenue that should not be reported on the commerce tax return. Those excluded items from gross revenue include the sale or grant of a right to use trademarks, patents, copyrights, or similar intellectual property, cash discounts taken by customers, the value of goods or services provided to customers on a complimentary basis, amounts realized from transactions described in several different Internal Revenue Code sections, which we'll discuss in a moment, the value of property or services donated to nonprofit organizations, and amounts that are not revenue under GAAP. To briefly summarize that reference list of Internal Revenue Code sections, we have the following amounts excluded from gross revenue: contributions to a corporation or partnership, corporate liquidations, liquidations of subsidiaries, certain corporate acquisitions, transfer of assets to a corporation in exchange for stock, corporate modifications and reorganizations, distributions from a partnership, like-kind exchanges, and involuntary conversions. These transactions represent transfers of assets that would otherwise qualify to be free from federal income taxation. This slide begins our discussion of certain types of gross revenue that can be completely deducted in order to report gross revenue on the commerce tax return. It is important to remember that although these amounts are referred to as deductions, they are not ordinary necessary business expenses. Instead, these amounts represent gross revenue that is not subject to commerce tax. These amounts include dividends or interest on federal or municipal securities, dividends and distributions from corporations or the proportionate share of receipts and income from LLCs and partnerships. This deduction is for the income resulting from a distributive share from a pass-through entity that would be reported on Federal Schedule K-1. The return of the principal amount of investment, return of the principal under a repurchase agreement, receipts from the sale of property used in a business except for inventory. This deduction is for the proceeds from the sale of an asset described in Internal Revenue Code 1231 or 1221. They represent depreciable business assets and capital assets of the business. Also deductible are receipts from the sale of an accounts receivable. This would be the income from the actual factoring of the underlying receivable. To continue with our discussion of deductions, insurance proceeds are deductible except for insurance proceeds to replace business income that would otherwise have been subject to commerce tax. Similar is lawsuit damages. Damages received in a lawsuit are deductible except for damages that replace lost income that would have otherwise been subject to commerce tax. Certain receipts from hedging transactions are deductible, as well as receipts from the business's own stock. Also deductible are amounts prohibited from taxing by constitution or law and the net income of a passive entity generated by gross revenue of another business entity. Thank you for watching this module. Please be sure to watch our other videos for more important information on Nevada commerce tax. Thank you.